Jared Dillian Show.
I'm Jared Dillian. This is the Jared Dillian Show. If you want to call to talk about your money, please call 844-305-7800. That's 844-305-7800. This is the Jared Dillian Show. You know, I should learn never to read stuff off my phone, because then if I don't touch the screen, it blanks out. I want to read an article I wrote in Bloomberg about gold. And this turned out pretty good. I'm pretty happy about this article. Usually, most of the time I hate the stuff that I write, but this actually turned out pretty good. So let's read this. And the article is called "Gold is a Hedge Against Bad Government Decisions." Investors don't really have a handle on what gold is or what it represents. Many erroneously believe gold is some sort of inflation hedge because of our experience in the 1970s. It's also not a hedge against stock market crashes, as we discovered in March. Gold is a hedge on government authorities making poor economic choices. Inflation is usually the result of those poor decisions, but people confuse cause and effect here. Gold is a hedge on policymakers screwing up, and there has been a lot of screwing up in the last 20 years. Gold has significantly outperformed stocks this century, gaining about 555% versus 79% for the MSCI All Country World Index of stocks and 146% for the S&P 500 index. This is a direct result of significantly looser financial conditions and no constraints on monetary and fiscal policy. From a financial perspective, the global economy is in a much worse place than 20 years ago, and there is no evidence that things are going to improve. The year 2000 is of interest because financial conditions were very tight at the time. In the U.S., the target federal funds rate was 6.5%. Real interest rates, or those after inflation, were strongly positive. The federal budget was balanced, and the dollar was strong and getting stronger relative to the other G10 currencies. This was when the strong dollar doctrine preached by former Treasury Secretary Robert Rubin was still being pursued. A strong dollar increased the attractiveness of U.S. financial assets, especially Treasury securities, which helped to keep borrowing costs lower than they might be otherwise. Financial conditions are much looser today. Interest rates are effectively zero and negative after taking inflation into account. The Federal Reserve has bought a range of risky assets in the course of pumping some $3 trillion into the financial system this year as part of its quantitative easing policy, and the U.S. budget deficit is its widest ever at $3.1 trillion. And of course, the Trump administration has been talking down the dollar for the purposes of increasing exports and manufacturing. True, the greenback is only back down to where it was in 2018, as measured by the Bloomberg Dollar Spot Index, which still makes it strong on a historical basis, but all currencies have depreciated a lot against gold and Bitcoin, which are supposed to be absolute stores of value. The phrase loose financial conditions is a polite way of saying that the people in charge are lazy. The argument for low interest rates is simple. Companies get to borrow more cheaply, encouraging them to spend more money on expanding plants and equipment and hire more workers. The argument for high interest rates are more nuanced. They're good for savers, but they also discipline companies and governments to operate more efficiently and reduce debt, or else suffer higher interest expenses. Likewise, the argument for a weak dollar is fairly straightforward. A cheaper currency allows U.S. goods to become more competitive overseas, boosting exports and manufacturing, which accelerates economic activity. The argument for a stronger dollar is more nuanced as well, in that a stronger dollar forces U.S. companies to make their goods more competitive or desirable in a global marketplace. With the benefit of hindsight, the period where we had strong currencies and high interest rates looks to be an aberration. There are few times in history when governments can resist the temptations of easy money and loose financial conditions. So if investing in gold is a bet on authorities doing the wrong thing, the best way to diminish the allure of gold and put the gold speculators out of business is to run balanced budgets. you have to be pretty cynical to root for gold to go up because it is an explicit bet on things getting worse. Cynicism is abundant. Nobody really believes that any government official has the political will to reduce or eliminate the deficit, talk up the dollar, or push the Fed into a more hawkish composition. What I'm describing, of course, is fiscal conservatism at a time when both Democrats and Republicans have become more fiscally liberal. It's worth pointing out that gold momentarily went up after the U.S. election results came in, and it became apparent that Joe Biden would become the next president, even though a divided government is the worst possible outcome for those betting on faster inflation. The market believes there will be deficit spending and inflation anyway. In the 2010 movie Inception, the protagonist, Dom Cobb, played by Leonardo DiCaprio, says that an idea is like a virus, highly contagious. The idea that we can print or spend our way to prosperity is very seductive. It takes no effort, but it's not how wealth is created. Wealth is created by individuals and businesses working for their own gain to the benefit of society overall. The job of the government and the central bank are simply to create the conditions necessary for people to prosper. They are not doing a very good job at it, judging from the price of gold. That is my piece on Bloomberg. That is a mic drop. That is a pretty good piece. I talk a lot about the year 2000. Because that was not just the top of the stock market. That was the top of civilization. And I knew it at the time. Things could not possibly get any better. Now, the stock market is higher today for a whole bunch of reasons that really have nothing to do with the economy. It has to do with the Fed. We talked about that earlier in the show. But the year 2000, we had very tight financial conditions. Interest rates were 6.5%. 6.5%. You could put your money in a money market fund and earn 6.5% interest. You have retirees putting their money in junk bonds, which are incredibly risky, trying to make 4%. You could have had 6.5% risk-free. The dollar was incredibly strong. We had a Treasury Secretary, Robert Rubin from Goldman Sachs, under Bill Clinton. And he's always said we have a strong dollar policy. We have a strong dollar policy in the United States, and the dollar got stronger and stronger, which benefited everybody. Then under George W. Bush, we had a couple of Treasury Secretaries. We had Paul O'Neill. Then we had John Snow. They continued the strong dollar policy. But John Snow would say, we have a strong dollar policy. And they would literally wink at the camera, and the dollar just got annihilated under John Snow. We had balanced budgets. Imagine that. We had balanced budgets in the United States. Our deficit now is over $3 trillion, which is over 15% of GDP. We had balanced budgets. We were having these arguments. We had a surplus. We were having these arguments about what to do with the surplus. And these were very impassioned arguments. On one hand, you had George W. Bush, who wanted to return the surplus to the American people in the form of tax rebates. On the other hand, you had Alan Greenspan, who was Fed chairman, who argued that we should keep the surplus to pay down debt. He ended up being right. We had high interest rates, a strong dollar, balanced budgets, very tight financial conditions. Today, we have very loose financial conditions. It's insanely different. Interest rates are zero. The Fed is buying every asset under the sun with printed money. You know, a lot of people just don't have this historical perspective. 2000 was a long time ago. That was 20 years. A lot of stuff can happen in 20 years. You know, and 9/11 actually had a big role in this. You know, once 9/11 happened, all the fiscal discipline went out the window. We created the Department of Homeland Security. In Bush's second term, for really no reason at all, we created a prescription drug benefit. We have a $3 trillion deficit now. This is the reason that gold has gone up. And gold, by the way, has not really been the best investment over the last couple of months, but I assure you that it is going to be the best investment going forward. Bitcoin is going bananas basically for the same reason. It's unbelievable. So the year 2000 was as good as it was going to get. And I don't know how bad things are going to get. One of the things that I think about is, since we have divided government, is there going to be any restraint on the spending side? One of the things that happened under President Obama, the first couple years of Obama's term, we spent incredible amounts of money. We had deficits of 10% of GDP. We had a deficit that was $1.8 trillion. Then the Tea Party happened. And the Tea Party elected a Republican Congress for the next 6 years of Obama's presidency and stymied any further spending. The deficit went way down. The deficit was $450 billion in 2014. And that might sound like a big number, but relative to GDP, it was only about 2%. So things are really, really, really not getting any better. But gold is not a hedge against inflation. It's not an inflation hedge. Gold is not a hedge against stock market crashes. What gold is a hedge against the people in charge doing stupid stuff. And they continue to do stupid stuff on a routine basis. I'm Jared Dillian. This is The Jared Dillian Show.
The Jared Dillian Show.